My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Adam Kobeissi. I'm excited for this conversation. I've been tracking Adam's work for some time. I know many of you have seen his phenomenal tweets. I think this will be a good conversation here. Adam, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? And what are you trying to do with your research?
Yeah, absolutely. Thanks for having me on, like these spaces that you guys are doing. My name's Adam. I started the Kobeissi letter back in 2015, so we're going on 7 years now. And I'd been trading stocks for a while before I even started anything that had to do with writing a letter or being on Twitter. And in the early days, technical analysis was still pretty young. Just about everybody was doing fundamental analysis, and when I draw lines on a chart, people would actually laugh at me. So I kind of developed this strategy where I use like a mix of fundamental and technical analysis in my weekly letter, and still do that till this day. And we've been able to outperform the S&P for the last 7 years in a row. And more interestingly, we think that technical analysis really is the future. And the reason we got into it was because of the fact that algorithms are now trading more than 50% of the daily market volume. And we realize that, fundamentals are a little bit more emotional based or a little bit more subjective, whereas technicals, yeah, you can draw lines differently, but, some technicals are so clear that just about every algorithm and every technical trader in the market is watching these levels. So if you can get ahead of that move, then, the majority of market volume is now moving ahead of your trade or after your trade. You can kind of front that. And we've seen this, work in the S&P, commodities, bonds, just about everything. And even with finance Twitter now, finance Twitter has continued to grow like crazy. We think that actually the amount of technical traders is actually growing just because of Twitter. So we think, the way we analyze markets is becoming more and more common. We're obviously always evolving. But over the last 7 years of writing, we've had a lot of success with our kind of unique approach to markets.
On the technical side, is there anything that would suggest that maybe the effectiveness has gone down over time? Because, as you noted, more and more people are following it, whether it's on FinTwit or through software packages. It's never been so easy ever in history to just have an automatic trend line or have different oscillators in the click of a mouse button.
Yeah, that's a good question. I don't think so, because honestly, the power in technicals is power in the numbers, right? The more people that are following a certain technical level, that's what makes it important. Otherwise, it's just really another level. So if people are all trading, if more people are trading on, the S&P, it's 41. Last week we saw that 4,100 was our target. We've been bullish with the S&P for the last 3-4 weeks. We were targeting 4,100. The exact high of the day was like 4,100.5. And then we're now down 80, 90 points from there. So, and this kind of stuff is happening daily throughout commodities and even individual stocks. So we actually think, more people following technicals on Twitter actually makes it even better.
So I shared in the Nest a tweet that you put out a couple of days ago where you basically summed it up by saying nothing adds up, which is the right of the equal sign, but let's go to the left. S&P falling like a jobs report, cancel the Fed pivot, fix down more than the S&P like we're in a bull market. Crude oil up like inflation's 10%, gold down like inflation's gone, bonds down like we're in a bull market. Nothing adds up. In a confusing environment, what do you tend to give more credence to? Fundamentals, which you can argue are maybe more objective and clear, or technicals where there is a lot of noise?
Yeah, that's a good question. I would say we lean more technical in markets like this because they are a little bit more clear cut. But this is a really interesting time because the markets are so focused on the Fed, and they're so fixated on the Fed that each part of the market is kind of trading differently. And then crude also has a bunch of other factors going on here. But this was more a point that it's been an interesting bear market because, number one, the VIX has yet to really spike anywhere. We're almost below 20 again. We were last week. The S&P, had one of its worst starts to the year. It's now in a situation where bad news is good news type of thing because the market really truly is so fixated on the Fed. So honestly, we think, technicals definitely are where we're leaning towards more now. But if you're able to get ahead of what the Fed's going to say. And obviously that's a big task. There is a lot of fundamental opportunity here just on the backdrop of the Fed alone. And the Fed also, this is something we've been writing too for subscribers. The Fed that's right now, that's the primary fundamental catalyst. But once the Fed, quote unquote, pivots and investors start saying, oh, okay, rates are done going up. Well, we still have a whole nother situation here where we are in a recession. We still have historically high rates. We have, rising credit card debt. Markets are still in volatility. So it's not like right when the Fed pivots, or, pivot is not even the right term, slows down and they start raising 50 or 25 basis points at a time, or even if they stop raising and keep rates where they are, we still have historically high rates into a recession, into, declining economic activity. So we're not really in the clear yet, but we have traded both sides of this so far.
So I like the way that you frame that different parts of the market are reacting differently, or maybe interpreting the Fed in different ways. For a good chunk of the year, as you know, there was pretty high agreement around stocks and bonds, in particular treasuries and stocks, on the kind of high inflation narrative. But the dollar didn't really, I'd argue, respond the way that most people would think. I made that joke before, right? If I were to tell you a year ago the dollar would have been the best inflation hedge, you would have thought I was crazy, but that's pretty much exactly what happened. Let's talk about sort of the evolution of the major asset classes, currencies, stocks, bonds, commodities, in the way that you've seen them interpret Fed policy moves, and maybe if anything has changed in the last month across the different asset classes' own interpretations.
Yeah, that's a good point. So the dollar kind of has been driving a lot of the different asset classes here. So like gold, for example, was something that everyone talked about. You had historically high inflation, you had market volatility through the roof, this uncertainty with the whole Russia and Ukraine situation going on. Gold was really unable to catch much of a bid at all this year. And a lot of this is because of the dollar. And the dollar still is, it has come down off the highs, but it still is pretty strong. We think what really happened here was, and especially earlier in this year, there was just every market was falling. Every Fed central bank was raising rates at a historic pace. And investors just said, what's the least bad market here? And money was really just funneling into the dollar for that reason. Even with inflation so high, I mean, this has kind of persisted. Commodities are really seeing the effect of this. We saw some effect on bonds, and that's exactly why when the dollar pulled back, you saw treasury yields start to pull back, and they're already now down off the highs. But yeah, I mean, we agree in what you're saying. It's a very interesting period right now.
What do you make of the some of the divergences that I think are starting to take place? I've kept on noting this point that I think, for whatever reason, whether it's FTX or something else that coincidentally is happening around FTX, that some of these intermarket correlations look like they're coming back, meaning you're seeing, the exception of today, again, back to hell, right? Stocks and treasuries had a few periods where they diverged. You had a pretty big break in the dollar post Powell's speech. Do you think now there's more sort of disagreement among the asset class as far as how the Fed should be interpreted?
Yeah, I think in a sense there is. And I also think that markets are just extremely reactive right now. I mean, they'll take a single word that Powell says and run with it and say, oh, Powell said, we want to be a little bit less, restrictive. And then all of a sudden this means the Fed pivoted and bonds are through the roof, stocks are higher. You mentioned FTX, which is interesting because we haven't really seen much of the spillover from that situation into equities yet. I mean, I know that has lagged in the past, but we haven't really seen much of an impact from that. And that could also just mean that we're still early and that there are many other crypto exchanges and parts of the crypto universe that are going to follow what happened with FTX. It's hard to say right now. Going back to your point about the Fed and divergence, I think the other interesting thing here is people are a little bit confused on risk profiles right now. I mean, the bond markets and some days are trading like the S&P's at 5,000. Some other days it's trading like we're down 50% this year. And there's never really anything in between. I mean, we saw the 10-year note yield swing like 30 basis points on Friday last week, I think, after that jobs report. So I think markets are just so fixated on what the Fed is going to do. And that's kind of causing these huge intraday swings that you mentioned.
There's a part of me that feels like the Fed wants to really, really, really invert the curve more than we've already seen. And I say that because it's, there's a mechanism there, right, in terms of incentivizing banks to lend. I mean, the more inverted it is, the less credit flow you're going to have. That's, again, typically sort of a sign of recession. It's also, you can argue, a cause of it. How do you think about the signal of the yield curve here? And because I think this is also where there's a nuance. Everyone talks about the Fed controlling rates. I keep going back to, they don't really fully control the long end, but they can drive a big inversion purely from the short end, independent of what the long end might be doing.
Yeah, I mean, the Fed realized that, number one, the only way that we're going to get inflation down is if we have a recession. And they actually said that a few times over the last year. And now, that's why we're seeing the yield curve inverted. We've been saying that we're in a recession ever since we had 2 straight quarters of negative GDP. And everything kind of still points to that. I mean, you can call it whatever you want, but we're in a slowing economy, and there are a lot of headwinds going on here. But the yield curve inversion is, I don't even think the Fed is really that concerned. They think, all right, well, we haven't had a recession in one of the longest periods in history without a recession. So if raising rates aggressively means that we're going to avoid inflation being entrenched in the economy, which was another big theme in their last meeting, then they don't really care if it's inverted, because they already said they don't care if we have a recession. That's how we're going to lower inflation. The question is, are they going to overshoot now because they're so hawkish and they're so fixated on getting rates down now? There's a possibility, like we saw after the financial crisis, that you could have a period of deflation before we get back to that 2% inflation steady state that they want. So, the yield curve inversion is definitely a hot topic, and it always generates headlines. But, we don't think the Fed is too concerned about that, especially because over the long term, that always normalizes.
Do you get the sense that maybe the Fed has overshot? And I say that only because, I've always had a problem with the narrative that the Fed has to hike rates to a level above inflation. The problem is inflation's lagging, and it takes time, right, for rates to filter through to the economy. It's my belief, I could be obviously totally wrong, that a year from now, it might be very clear that they overshot. But I'm curious to hear your thoughts in terms of where that sweet spot is and where they may have, or either going to cross or may have already crossed it.
Yeah, that's obviously the $1,000,000 question. It's hard to say, because they are, you're in a way, you're using data that lags to determine if inflation has peaked or not. If they we expect them to raise 50 basis points this month, and maybe 25 in January, depending on what happens with the November CPI. I think we're getting near that point. And the Fed really needs to take a more cautious but hawkish outlook. That's what we're calling for. If the Fed, continues to raise aggressively, and the December, or the CPI that's coming out in December for November, this is a huge report. If this comes in higher than 7.7, or even like above 8, then this really increases the risk that the Fed overshoots and tightens too much. So next week is probably the biggest week of the year. I mean, you have CPI, you have the Fed, and everyone's waiting on the pivot. And we've been calling for, a buy the rumor, sell the news type of event. We were on Fox Business last week and kind of echoed the same thing. But for those that didn't tune in, I'll reiterate. We've been bullish for the last month or so of equities, and every single Fed meeting this year, even last year, we've seen the decision priced in well ahead of what happens. And really what ends up happening is the opposite price action of what occurred for the last month or two happens after the meeting, barring any crazy statement from Powell in the press conference. So we've been bullish, and we think that the Fed's going to come out, they're going to raise 50 basis points, but they're going to stick with this theme. And even Powell said it last week when everyone said he pivoted. He said it then too, that they want to start, considering less hawkish policy. They're still hawkish, but they also want to make sure that rates are sufficiently high to bring inflation down and lower risk of inflation entrenchment. So this is kind of creating this perfect, buy the rumor, sell the news type of environment that we think is going to come to fruition next week.
I have not tracked this that closely. I see the headlines, and I see a lot of people saying that this is one of those situations where if there's smoke, there's fire. The situation with Blackstone limiting withdrawals. I don't know how much work you've done on this, but I'm curious to hear your thoughts on if you think that's maybe a one-off, or if that's sort of the maybe the first real sign that they've maybe overdone it.
Yeah, I haven't done too much work with that. I saw. Are you talking about their property fund where they limited the
Yeah,
withdrawals?
exactly. Right.
Yeah, I think this is the first sign of institutional capital just beginning to show a little bit of panic, especially in the real estate world where prices are finally starting to come down, rates are soaring. We don't think that this is a 2008 style housing market where everything's going to come crashing down. You will see institutional capital start to pull back, but that's just natural. I mean, that's happened. It happens in private equity. It happens all across finance, and this is the first sign of that institutional capital pulling back. And we think that the housing market is actually kind of lagging a little bit here. So we think that in the first couple quarters, Q1, Q2 of 23, is when we're going to start to see the real decline in markets, in the housing markets. But nothing really beyond, a standard bear market, I guess you could say, maybe a 20 or 30% pullback in prices. And this is on prices that are already up at a historic pace over the last few years. So we're not too concerned about that right now. If you start to see funds all across Wall Street starting, having this investor rush saying, "Oh, we want our money back," that's another thing. But not really something we're watching too closely right now.
Yeah, I'd agree with you. I mean, the challenge there is that if it ever got to that point, then presumably markets would have already dropped a lot, as that's happening or just prior to that happening, kind of sensing or sniffing it out. That's kind of the challenge always with these type of environments, right? You don't know if it becomes a domino, but by the time it looks like the dominoes are falling, you've already probably taken a big hit.
Right. That's a good point. I mean, it's always easy in retrospect. Basically, is what you're saying. There's a fine line between being ahead of something like that and also just panicking and missing out on opportunity because you took all your money out or you sidelined yourself too quickly. I think the best way to approach this market, honestly, right now is if you're trading, trade with stops, right? I mean, it's very, and that's why technicals are so beautiful. It's very easy to tell when the trend breaks. I mean, you might cost yourself 50 points in the S&P, but if you're making higher highs and higher lows, and that's what we've been watching. Like last week, for example, we made another higher low in the S&P at 4080 and then another higher high at 4100. In that sort of environment, we just continue to play the trend. I mean, the trend has truly been your friend in this market. So instead of panicking at headlines and looking at these fundamental things that are, obviously very hard to forecast, we're more focused on where is the current trend. Even if we're in a bear market rally, there's a lot of opportunity to both sides in this market.
So there's a question of where's the current trend, and then where is the highest conviction by the crowd. I tend to be contrarian in the way that I look at things, and I use a lot of FinTwit sentiment as I am very allowed, right, and to kind of use as a way of validating maybe a counter opinion. And I say opinion purposely because everything's an opinion when it comes to the future. Nobody knows, except for hindsight. I'm curious, just from your own sense of things, maybe from subscribers or people you've talked to, where is the conviction highest that maybe makes you a little bit worried?
I think if you asked me this question a month ago, just about everybody was bearish, and there's strong conviction that there's no buying opportunity in sight. I mean, this rally is extremely similar to what we saw in June through August of this summer, and I think even on a percentage basis, it's pretty similar. Where everybody now wants the Fed pivot, and it's now the bullish train to the moon type of thing on Twitter. So that's when we start to get concerned. I think that's also kind of supports our thesis of buy the rumor, sell the news. I mean, whether that means the S&P is going to crash all the way back down to 3,500 or 3,000 that people are calling, it's still very early to determine that, and it's going to be highly dependent on the Fed and technicals, but the Fed's probably going to break technical levels to both directions. So for now, we're not. The sentiment on Twitter is bullish. I don't think it's overly bullish yet, but it is certainly setting up for a pullback at some point, especially when this near-term uptrend breaks. And that's the point when you can say, was this a bear market rally or is the bottom in? It's regardless if it's a bear market rally or the bottom is in, we don't think it's going to be a clear coast higher in S&P to 5,000 type of thing. Even beyond the Fed, pivoting, like I said earlier, there's a lot of other headwinds in this market right now.
But I also do think, Adam, there's another aspect to this, right? When you think about technicals and tail risks coming from a macro perspective, are there certain charts that you pay more attention to as an early tell? Lumber to gold, utilities, moving averages has some degree of predictive power there, but do you like to focus on certain areas for sort of earlier warning signs than others?
I think we've been talking about the dollar. That's definitely been the dollar and bond markets are actually pretty well in sync here. So we've been seeing the move in, the dollar. Once the dollar started to pull back, and if the dollar index, for example, drops below 100, that's a great sign for bulls, because that's opening the path for more downside in treasury yields, more upside in bonds, and the S&P is going to follow. If the 10-year note yield drops to 3%, we'll see the S&P 500 much higher than it is now. It's hard to say what's moving first right now. I think everything's kind of moving together, and at some points nothing really makes sense. At some points everything makes sense. But we take more of a holistic approach and kind of watch everything, I guess.
Is there any particular asset class or trade that's gotten choppier as the year has progressed? I mean, I'm going to assume oil is part of that, but I'm just kind of curious. I don't my approach is much more condition oriented rather than level oriented. But is there anything that's been more difficult throughout the year?
Yeah, one of our assets that we cover and we've talked about a little is gold. And gold has been just like, if you're a fundamental trader trading gold, like, this market makes absolutely no sense. Gold should have been at 3,000 based on inflation and volatility and whatnot. But obviously the dollar has limited things here. So that's been a really interesting trade. And now we see gold back around 1,800, and it's like, you're either staring off a cliff or the Fed pivot is coming, and then you can breathe a sigh of relief. But it's been very choppy for the last few months, and we think that's going to continue. Just the fundamentals are so mixed here that it's hard to see a sustained rally in gold. And then anytime that the downtrend starts to pick up momentum, this Fed pivot narrative comes back into play, and this leaves the chart just basically in range bound for the last few months. So that's been a real choppy trade that we expect to continue.
For the life of me, I keep going back to, I can't understand the obsession everybody seemingly has with a Fed pivot when all of history suggests that that's actually not a good thing. Now, I know that obviously, it's probabilities, right? So maybe it will be a good thing this time around, but it is amazing to me how people latch onto a one-liner and don't even do any kind of test to see if it's true.
Right. No, yeah, that's true. I mean, this could be something really that, Twitter has amplified. Honestly, there's so much capital in this market that's just following headlines, and whatever the newest headline is what's driving price. So now it's like this, the pivot, the Fed pivot, quote unquote Fed pivot, has become the key event that everybody needs to end this misery, right? And once the Fed pivots, it's all the grass is greener, which is definitely not the correct narrative. It might cause a near-term rally. It might mean that rates are not going higher, but it doesn't mean that we're in the clear and we're running and there's not other headwinds in just about every other part of this market. So I mean, that's something that we've been very cautious about too. Even calling a Fed pivot is really misleading. I mean, if the Fed raises 50 basis points right now, with rates already historically high, I mean, that's still very hawkish. If you would have gone back 5 years from now and said, oh, the Fed's raising 50 basis points, the market would have been down hundreds of points because, oh, we wanted a 25 basis point rate hike, or we wanted rates flat. So it's all relative, and you got to be, in market conditions like this, you got to be careful to run with a narrative and just believe that once that happens, everything is good to go. Or in the opposite direction, once something happens, oh, we're going to crash. Like these conditional statements that are just based on one condition, generally those are misleading and not the best way to handle markets.
Okay, so that goes actually a little bit to the name of the space, which I named it purposely. The Fed knows something that we don't. Now, I am of the, again, opinion that it's funny because a lot of people seemingly have different viewpoints on this. Actually, dear point, I'd like to hear your thoughts on this too. John Malden retweeted, and I'm a big fan of John's work, basically saying that he doesn't think that Powell's tone was a change at all, that Powell didn't say anything differently, that they're still on the Fed hiking warpath, cycle. But a lot of other people will say, well, no, actually, quite the contrary. It looks like he's kind of toned down his aggressiveness. First of all, what's your take, Adam, on last Friday's Powell, conversation? And is there? This is the thing that bothers me. It's just there's a part of me that feels like Powell is hedging just in case there is some kind of tail event out there because of this crypto collapse.
Yeah, absolutely. I mean, this is what we've been writing for subscribers all year. The Fed has really been hedging the entire year. In a way, the Fed, if you compile every statement that the Fed has said, I mean, we made a tweet about this on November 30th, where we said, in November of last year, they said inflation is transitory. Then they said it's not transitory in March. And then they said you need a recession in June. Now they say you might have a path to a soft landing when we've already crashed. So the Fed has been hedging themselves throughout the entire course of this bear market. And they know that if the December CPI or the November CPI report and next week comes out and at 8% or above 7.7, well, now they're back in the same exact spot they were at when we had this bear market rally in the summer. And they can't say that we've pivoted or that keyword the market is looking for, because if they say that and then now inflation actually didn't peak or it's still at a historically high level for longer than they wanted, then they got to go all the way back to their hawkish mode again. So they are for sure hedging to both directions, and that goes in the other way. Whereas if inflation keeps falling hard, then they're even, we've seen Fed fund futures showing the possibility of rates being cut in 2023. So they know that really anything in the entire spectrum can come to fruition here, and they're hedging to both directions, because if they don't keep rates high enough for long enough, then inflation is going to become entrenched in wages, and this was something they talked about a lot last month. Whereas if it comes down quicker than they expected, then they're risking overshooting. So absolutely think the Fed is hedging, and they're going to continue to do that at this month's meeting. I mean, yeah, on the consumer side, there definitely are some cracks that we're seeing where, what's been interesting and something that I think markets have kind of overlooked was just looking at retail earnings. Last quarter, we saw Target and Walmart start to really note the impact of inflation on consumer spending. And this quarter, they kind of reiterated that, but markets kind of completely ignored it because, the Fed's going to pivot. So the consumers are definitely starting to crack a little bit here. And also something we've been commenting on is just rising credit card debt levels. Consumer sentiment is still historically low. It's interesting, right? Because the Fed's almost behaving like we're in a bull market with raising rates so aggressively, and it's so counterintuitive when you think about it. But consumers on the other hand are starting to feel the pain, and it's going to create an interesting 2023 for sure.
Well, it's also important to note, I did catch some of what Powell was saying Friday. He said he alluded to something I've said a number of times. It's like you got to be careful with any sort of analysis where the sample size is 1. He actually said where n equals 1, right? I think that's what he referenced at some point, right? So this is the other thing too. It's like the market assumes that the Fed has perfect control and power over macro dynamics, but even Powell himself is admitting that they don't really have any map to go with on this.
Absolutely, and this is something else that we've been talking about a lot for in our newsletter. The Fed really only can control demand side inflation, and that's what's been such a struggle here. Supply side inflation has been just as bad, if not worse, than the demand side, and the Fed has basically no control over that. What's happening is, and this is another reason why we thought the case for deflation and even over tightening is possible. They're almost at the mercy of supply side factors, and they don't know when these factors are going to come down, when supply side inflation is going to ease. And what that means is if it eases too quickly and they're too hawkish, well, then that's the case for over tightening, and that you might even see deflation. So, n equals 1, that's a great point that you mentioned. And on the other side, they only control half the picture here. The Fed is absolutely not the only person in control, the only entity to blame here, if there even is anyone to blame. But it's not just the Fed driving the show, even though it might seem that way.
It is interesting, right? And so this is, and I think, Adam, this is kind of it's an interesting thought experiment, right? Higher rates will only really, you can argue, create a severe crisis when you have a bulleted rollover of debt, right? I mean, you can argue that's part of the reason why high yield has done much better than people realize or would have thought, including myself, because a lot of the high yield issuers locked in low rates, and it'll take time for that debt to eventually roll over. And the question is, at what point in the interest rate level will they roll over? How do you think about credit maybe more broadly, Adam? I know you talk about technicals and fundamentals, but technicals in the bond market, there's still merit there if you're thinking about it from the standpoint of spread widening and, again, the risk of rollover with whether it's BIS or junk companies. That's sort of a constant risk that could be interesting from a timing perspective.
Yeah, the first thing I'll add is we're always cautious of these reports that come out, and not saying they don't have merit and they don't have a point, but some of these are just a little bit, they invoke fear mongering, I feel like, and you got to be a little bit careful where it's not like you were saying, Michael. It's not always a linear thing where we have high rates and we have this historically high debt level and now everything's going to collapse. And I think that's something that people are a little bit cautious about, just because we're coming off the financial crisis when we had one of the worst collapses of debt ever. But it's hard to say right now. And it's also hard to say how high rates or how long rates will remain this high. And because if inflation really starts coming down quickly, we see a path for rates to come down relatively quickly. I mean, we could start seeing rate cuts in the second quarter of 2023. And if you look at Fed funds futures, they're actually forecasting rate cuts in the second half. So, to say that, when rates are so high right now, does this mean that we're on the brink of a collapse and every country is going to have a severe crisis? I mean, we think that's a little bit early to say, and it's definitely something good to keep in mind, but not something that we're too worried about right now.
Yeah, I'll tell you, it'll be interesting to see how that plays out if the Fed hikes rates while headline CPI is still solidly above 2%, which they'd have to do, right? Because again, inflation's lagging, but most of the public doesn't realize that. So the moment the Fed does end up cutting rates with inflation headlines still being elevated, there's going to be a lot of pressure and political backlash, which is misguided, but might also impact their trigger happiness to do that.
Yeah, absolutely. I mean, there's the Fed is trying to, they always come back to their statement where we're acting on our mandate, right? And they're not politically driven or not really considering what equity markets think. So, it's important that the Fed continues to just stay in their realm and not be too driven by outside factors, because right now is kind of crucial. I think they're still thinking in the terms of maximizing short-term pain to minimize long-term damage. So for now, it's tough. I mean, I don't think the Fed should be politically driven, and we don't really comment on politics much, to be honest. But the Fed has really, just been data driven so far, and hopefully that remains the case.
For the remaining few minutes here, Adam, any sort of final thoughts or things that are really kind of getting your attention more recently that you're maybe highlighting in your research?
Yeah, I mean, we've been watching. Markets have become very global, right? It's not, and this was something that was highlighted in the whole situation with Russia and Ukraine. You can't have parts of this market siloed off. I mean, the global economy is so interconnected. So it's you've seen like the COVID restrictions in China, for example, have been a big headwind that kind of caused some volatility over the last couple of weeks, and in crude oil, same type of thing, and also pressuring consumers. So, our overlying theme here is the Fed's in focus right now. Markets are very interconnected. So everyone's kind of reacting to what the Fed's doing. But once they do pivot or slow down, which we do expect to happen at this month's meeting, it doesn't mean that we're all of a sudden in the clear. It doesn't mean that S&P is going up 20%. And honestly, we think that there's a lot more opportunity coming. And markets in general, markets are a very interesting spot where people in life in general, people hate uncertainty, they hate change, they hate volatility. But in markets, this is really the biggest opportunity. I mean, these volatile market conditions only come every few years, and when they do, they're brief. So view change, view uncertainty as opportunity. Don't have an aversion to it, which is a natural human instinct. And we think that even though we've fallen 20-30% at the lows this year, there's still more opportunity to both sides in this market. So remain objective and don't trade with emotion.
I think that's a good place to end the space. Thank you, everybody, for joining. I'll have this as a podcast in a couple of days here. I'm doing another live space at in about an hour, actually, noon Eastern with Peter Spinos in the space here. Thank you, everybody. Thank you, Adam. Really do enjoy talking to you and listening to you, and everybody enjoy the rest of your day.
Thanks for having me on. If anyone has any questions, feel free to tweet at us or email us, and we're happy to follow up.
Very good. Thank you, everybody.